You spend fortunes on speed. You invest in swift wires, in brilliant screens, and in mechanical assistants designed to win a fraction of a second. You believe this machinery gives you an edge. But let me deliver the brutal truth of the street. All that technology, all that blinding light is actively obscuring the reality of the market. It is making you dull. You are relying on depictions of reality, not reality itself. You have filtered the signal into silence. Your indicators, your moving averages, your sophisticated arithmetic, they are all filtering the only thing that matters: the immediate physical flow of bids, offers, and executed transactions. This flow is the engine room of speculation. I did not need a single one of your computing devices. I required a ticker tape. That simple machine spoke a language you have forgotten. It spoke the language of human panic and human greed in real time. The tape never lied. It never calculated an average. It never smoothed out the volatility. It simply delivered the raw electric pulse of money-shifting hands. If you cannot read that fundamental flow, if you cannot distinguish the sound of conviction from the whisper of fear, you are simply watching history repeat itself on a brightly colored screen. You are not anticipating the future unfold. You are always late. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. You look at a chart. What do you see? You see a rectangle, a colored block, a candlestick. You call it price action. I call it a cemetery ledger. A candlestick chart is a funeral home for price action. It documents precisely where price died over a fixed period. It is a record of a settled account. It is history. It is documentation. Reading the physical flow, watching the tape, seeing the book of orders, that is being present at the birth of every movement. It is being present for the argument itself. The flow is the cause. The chart is merely the effect, the residue left behind when the argument is concluded. You study the size of the candle body. I study the speed, the aggression, and the sequence of the transactions that force that candle to form. The color of the box is irrelevant. The desperation behind the transactions is everything. A large green candle only tells you buyers won the minute. The tape tells you how they won. Were they timidly buying small lots, slowly grinding higher? Or did a powerful operator step in, sweeping the offers in rapid succession, displaying unshakable financial muscle? The flow shows the urgency. The chart only shows the conclusion of that urgency. The most crucial information is not the close price. It is the texture of the movement leading up to the close. It is the sudden appearance of heavy orders, followed by their instant execution. You must train your eye to see the movement between the points, not the point itself. The chart is static. It is a photograph. The flow is kinetic. It is the drama unfolding. The man who trusts the photograph will always be trading yesterday's reality. The man who reads the flow is trading in the moment of creation. He is there when the smart money commits. He is there when the lambs are being led to the slaughter. The reliance on these historical depictions, these charts, is the fundamental flaw of the modern speculator. You worship the history that your indicators are built upon. You ignore the volatile, immediate reality that is unfolding right now. Forget the shape of the candle. Listen to the rhythmic pounding of the transactions. That is the heartbeat of the market. Charts are graveyards. I use that term deliberately. Every price bar is a memorial to transactions that are finished, concluded, and past relevance. The modern trader waits for confirmation. He waits for the 5-minute bar to close or the 10-period line to cross over the 50. He waits for history to solidify. This means he is trading on data that is several minutes old. In a speculative market, several minutes is the difference between a handsome profit and a disastrous loss. The physical price flow dictates that by the time your moving average triggers, by the time your oscillator confirms the direction, the smart money, the money that controls the tides, has already positioned itself. They acted on the first whispers of change. You are reacting to the shout that followed. The key is to see the persistence in the flow. It is not enough for a few large bids to appear. It is critical to observe sustained interest. Does the selling abate immediately after a small decline? Are persistent bids arriving in increasing size and at an accelerating speed? This sustained interest, this building of pressure, precedes the visible breakout on your chart. When you see a large order execute, look immediately at what happens next. Does the price stall, absorbing the pressure, or does the price leap forward, energized by the transaction? If the price leaps, the resistance is thinner than the chart suggests. If you wait for the bar to close green, you have missed the aggressive buyers who arrived during the first 3 minutes of that bar's formation. The professional acts on the first sign of sustained interest, the sustained commitment shown in the tape's acceleration. The amateur waits for the indicator to fire. By the time the indicator fires, the professional is already setting his stops and calculating his exit, knowing the initial movement is exhausted. You must learn to trust the raw velocity of the ticks more than the settled geometry of the charts. Volume is the breath of the market, but most speculators fail to measure the conviction of that breath. They simply look at the size of the bar at the bottom of the screen and conclude, "Ah, heavy volume." That is lazy thinking. In the physical flow, high volume must be assessed against the rate of change it produces. Volume is only meaningful if it accomplishes something. Is the volume moving the price aggressively? Is it ripping through offers or bids without hesitation? That signifies absorption of supply or demand. That is the sound of conviction. Or is the volume simply churning price in a tight, confined range? Transactions are heavy, but the price hardly budges. That signifies accumulation by large operators or careful distribution into unwary hands. This is the deceptive volume. It looks busy, but it lacks kinetic purpose. Conviction never sounds timid. Conviction sounds like rapid sequential ticks driving the price relentlessly higher or lower. Ticks that are tightly grouped, accelerating in speed, covering significant ground in a matter of seconds. It is the market clearing its throat. If 1 million shares trade and the price moves 5 cents, that volume is frictional. It is noise. It is the market settling internal disagreements. If 50,000 shares trade and the price moves 50 cents in a minute, that is conviction. That is a strategic player forcing the issue. The depth and size of the orders hitting the tape must always be weighed against the result. You must listen for the quality of the movement. A transaction that causes a sudden, sustained acceleration tells you that a crucial level of resistance has not merely been hit, but destroyed. The volume was sufficient to sweep away all the pending offers waiting at that price. This is the power of the tape, assessing whether volume is fuel that propels or simply friction that arrests movement. I always sought the line of least resistance. The market, like water, follows the easiest path. The professional speculator's job is to locate where the market gives up, where the defenses crumble and the path is cleared. In the physical price flow, in observing the book of bids and offers, this is revealed by the sudden disappearance of support or resistance when pressure is applied. Watch the posted orders. These are the defenders of the price. Suppose a stock is trading at $80. There are 20,000 shares listed as bids to buy at $79.98. This is the first line of defense. The sellers begin pressing. They hit the tape with transactions. The price ticks down. $80, $79.99. The key is to watch what happens to that 20,000 share bid at 79.98 as the selling momentum increases. Do the sellers eat into the bid slowly, transaction by transaction? That suggests measured retail selling. Or does the 20,000 share defense suddenly vanish? Does it instantly drop to 2,000 shares or disappear entirely, and the price instantly slips to 79.90? That moment, when the defenders retreat, when the visible liquidity dissolves, is the instant of maximum opportunity. That vanishing act signals the path of least resistance. The sellers have realized there is no sustained support beneath. The momentum will immediately accelerate, sucking the price downward. This slippage, the failure of the expected depth, is the purest signal the tape can give you. It tells you not only that the market is weak, but that the large, resting orders are canceled or pulled back by fearful professionals. The line of least resistance is found not in the strength of the attack, but in the weakness of the defense. The modern speculator relies on his computer to retain information. I relied on my memory. My mind was my analytical engine, my supercomputer. To truly read the physical flow, you must develop a market memory. You must memorize the size, the timing, and the consistency of the bids and offers that previously failed to move the price. This provides context. The market never acts in a vacuum. If a stock has been stubbornly refusing to trade below 95.00 for 2 hours, if every dip is met with 30,000 share bids that hold the line, you have established a critical piece of market character. 95.00 is a fortress. You then observe the flow. The selling pressure increases. Suddenly, a strong bid that has been holding firm at 95.00 evaporates. It is pulled, and the very next transaction executes at 94.98. The memory of that prior strength, the knowledge that 95.00 was a fortress that required monumental effort to build, is the critical signal. The market character has fundamentally shifted. The defenders have capitulated. This memory prevents you from mistaking genuine weakness for mere fluctuation. You know the price point was tested, proven strong, and has now failed. Without this memory, every tick below 95.00 looks like noise. With this memory, that tick below 95.00 is a cannon shot, signaling the end of an accumulation phase and the beginning of a decisive markdown. The greatest value of the tape is its relentless ability to establish patterns of defense and aggression. When the pattern breaks, when the defense folds, you must be ready. Memory is the scaffolding of anticipation. The physical flow reveals the dirty tricks. It exposes the manipulation attempts, the stops being hunted by large operators seeking cheap inventory. This behavior shows a specific signature on the tape. I call it the flinch. Large players need liquidity to enter or exit large positions. They know where the retail public and weak-handed professionals place their stops. Just below a visible support, just above a visible resistance. Watch for brief, aggressive flashes of volume. The tape shows rapid transactions that push the price just outside a known support level. Say a quick drive below 50.00 to 49.95. The intent is to trigger the sell orders sitting beneath the round number. But here is the distinguishing characteristic. The price does not follow through. It immediately recoils back to the mean. It reverses with urgency, often filling back up to 50.05 within seconds. The stock flinched. It dipped, collected the liquidity, and snapped back. The large player was sweeping the dust, collecting shares, not initiating a sincere directional move. A genuine breakout requires sustained volume and follow-through. It requires the price to stay broken. A stop hunt is a quick thrust, a rapid collection, and a rejection of the new low. If you're watching the tape, you see this failure to follow through instantly. The moment the bid evaporates and the price flashes lower, you watch the bids at the low. If new, large bids reappear almost immediately, sucking the price back up, you know the maneuver was insincere. The flinch is confirmation that the large money is accumulating, using fear to shake out weak holders. Never confuse a swift dip for a breakdown. Study the immediate recovery. The recovery is the truth. The bid-ask spread is the most honest measure of market fear and uncertainty. It is the distance between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Chart traders ignore this metric entirely. They focus only on the last executed price. They are deaf to the conversation of liquidity. The spread is the expanding whisper. It tells you what institutions are truly thinking about the immediate volatility and the depth of the market. When the market is confident and liquid, the spread is tight, perhaps a single cent. Buyers and sellers are close, signaling deep confidence that they can transact without moving the price against themselves. But watch what happens during moments of uncertainty. A rapidly widening spread, even if the price is holding steady and without massive volume, signals institutional nervousness and reluctance to fill orders. The sellers are demanding a higher premium to part with their shares. The buyers are demanding a greater discount to commit capital. This rapid expansion indicates a deterioration of liquidity and signals immediate volatility risk. It means the available depth, the number of resting orders, is thinning out drastically. A single medium-sized transaction can then rip through the entire book. If the spread expands from 2 cents to 10 cents in 30 seconds, it does not matter what your chart looks like. The market is about to become disorderly. You must pull back. Conversely, a rapidly tightening spread signals returning confidence and increased market depth. The fight is settling, and operators are confident enough to place their orders closer together. The spread is not about direction, it is about market health. Neglect it at your peril. It is the first sign of a coming storm or the first breath of returning calm. If you enter a position based on an insight derived from the physical price flow, the confirmation should be near instantaneous. This is the non-negotiable demand of the tape reader. If I observe the line of least resistance open up, if the offers vanish and the momentum shifts, I commit. And the very next sequence of ticks must validate my entry. If I buy, the price must immediately tick in my favor. The bids must hold firm and the transactions must continue to execute higher with aggression. If I buy and the stock hesitates for 30 seconds, or if the bids quickly thin out, or if the price ticks back to my entry price, the flow is telling me with brutal clarity that my timing is wrong. The flow demands strict, immediate validation. I do not wait for the 5-minute candle to close. I do not wait for the chart to confirm my decision. The tape is the confirmation. If the immediate transactions do not support the trade, the initial analysis was flawed, the timing was premature, or the observed momentum was exhausted before I could act. In that situation, I exit the trade immediately. Small loss. Move on. The chart trader, relying on delayed confirmation, waits for the moving average to cross back down. By then, his small theoretical error has become a substantial realized loss. The tape reader is disciplined by immediacy. The flow acts as an immediate truth detector. If the market does not endorse your decision instantly by moving in your favor, you have made a mistake. Honor the market's instruction. Cut the position. The conviction must be validated on the first 3 ticks. If it is not, it was false conviction. The modern speculator surrounds himself with complexity. He has 6 screens. He has a dashboard of blinking lights, 20 indicators running, and constant news feeds chattering in his ear. This environment encourages paralysis by analysis. It is designed for comfort, not observation. The deception of the dashboard is that it confuses information overload with wisdom. The physical flow demands simplicity. When I was in my prime, I needed only the tape. Price, size, and speed. That was the entirety of the input. True observation is inherently uncomfortable. It requires intense, focused concentration on raw, unfiltered data. It is mentally exhausting. Your modern dashboard encourages intellectual contemplation. It allows you to ponder the divergence of the stochastic oscillator against the relative strength index while the price is running away from you. The raw flow forces decisive action. You cannot rationalize with the tape. It simply ticks. It forces you to make a binary decision based on the immediate action of institutional money. The comfort of multiple screens, the illusion of total information control, kills the vital observational sense. It dulls the intuition. The professional must embrace the discomfort of staring at the unadorned, chaotic reality of the flow. He must train his mind to filter out the noise and isolate the core signals. Is the speed increasing? Is the size committed? Is the direction holding? Strip away the complexity, remove the crutches. Focus only on the beating heart of the market, the execution of orders. Decisive action only comes from clear, focused input. The dashboard is designed to muddy the water. The ultimate power of reading the physical flow is the conversion of observation into unshakable conviction. This is the apex of speculation. When you observe a fundamental shift in the tape, the speed, the size, the relentless direction, you do not need outside validation. You do not need a broker's tip or a chart pattern to confirm your insight. The tape tells you precisely where the institutional money is defending its turf or where it is launching its attack. If you see a large distribution take place for 3 hours, and then you see the bids fail at the critical support level, and the subsequent transactions accelerate rapidly downward on heavy volume, the entire sequence aligns perfectly with a short thesis. Your conviction is absolute. It is built on empirical, real-time evidence of capital movement. This certainty is what allows the professional to execute the proper position size. The amateur, trading on external signals or delayed charts, hedges his bets. He takes a small position because he lacks confidence in his source of information. He relies on hope. The tape reader knows. He has watched the transaction unfold. He can commit capital decisively. The size of the position is determined by the clarity of the signal. When the flow aligns perfectly with your thesis, speed, size, and direction all confirm the movement. You have earned the courage to execute the position size that defines a professional operator. This conviction is the shield against fear and the engine of profit. It is born from witnessing the truth, raw and unfiltered as it unfolds on the tape. The foundational principles of market mechanics we have just analyzed, the reading of the physical price flow, are often acquired only through the costly errors and sharp market penalties inherent to speculation. Fortunately, the necessity of paying that price is mitigated by the historical record. In 1923, Edwin Lefebvre gave us Reminiscences of a Stock Operator, meticulously detailing the career and philosophy of Jesse Livermore, known therein as Larry Livingston. This essential text serves not merely as history, but as a sophisticated training ground for the modern mind, allowing one to internalize the discipline of price action vicariously. Crucially, the Max Davidson edition adds indispensable modern commentary, ensuring the wisdom codified nearly a century ago is fully translated and actionable for today's electronic markets. To equip yourself with this foundational wisdom and bypass needless on-the-job error, a link to this essential edition is provided in the description below. The market doesn't speak in colors, lines, or sophisticated arithmetic. It speaks in speed, size, and urgency. Your modern technology is designed to make you comfortable. It creates smooth lines and elegant graphs. But comfort in trading is a slow death sentence. You must embrace the raw, visceral reality of the market. You must learn to hear the conversation between panic and greed as it is being typed out, tick by tick. Learn to read the action, not the depiction of the action. The price flow is the immediate language of money. It is the voice of the house. Master that language, and you will master the game. You will never again rely on history to tell you what is happening right now.